Hey everyone. Happy Monday, May 19th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an actually beautiful Redmond, Washington. We had not surprisingly, kind of a rainy weekend here in Redmond. And today, sort of back to the weather I feel like we wish we had over the weekend, which is sunny, highs in the 60s, nothing to worry about weather-wise. Kind of windy, though, which is a little rough, but we'll take it. Hope you guys are all doing well. Hope you're doing great here on a Monday after the weekend. The market's opening in a position of weakness after the Moody's downgrade, which happened after the close on Friday. Maybe investors had all weekend to stew on the reality of it. Maybe it was much ado about nothing. But after the S&P opening around 5,900, ended up pushing higher going into the afternoon. Ended up finishing toward the highs of the day. So the S&P and the NASDAQ you're going to read as flat, but it was a nice accumulation coming out of a very weak open. Leadership days continuing, or leadership themes continuing to be top of mind here, with healthcare, one of the worst performing sectors recently, here at the top of the list. So a lot of things to dig into. We'll talk about a couple of charts that are sort of top of mind. I did a webcast or a show earlier on Stock Charts TV called digging into price gaps, basically, and looking at some of the price gaps we've seen recently. We're going to dig into First Solar, I think was the one that I grabbed a little bit earlier. We also talk about some of the strength in industrials, which has ended up being one of the stronger sectors on a relative basis. Let's get to the charts here and look at how the markets played out on a Monday. Again, with the weaker open, here's the S&P opening around 5,900, below Friday's open and below Friday's entire range, closing above Friday's range. So talk about a nice upswing through the course of the day. That makes the S&P basically 5 points higher. That's not much. That's 0.1%, 0.1%. We'll call that essentially unchanged today. But again, I think that minimizes the strength of the rally off of the weaker open. The Nasdaq flat for the day as well. The Dow finishing about 1/3% higher. Mid caps and small caps both in the red. I get sort of random questions always about whether small caps are going to be an interesting place to be. My standard response continues, which is until you see some relative performance better than what we're seeing here, it's just not worth our time and attention. And when you look at measures of breadth, when you look at measures of momentum, when you look at measures of trend, small caps underwhelming versus the S&P on most timeframes I care to think about. Year-to-date returns, small caps are not the place to be. At some point, that probably changes, but that point is not today. The VIX moving slightly higher there, and while the S&P, again, finished in the green, it was definitely a volatile session in terms of the lower open and the swing up to the higher close. So the VIX did move almost a full point higher. We're still below 20, which would mean sort of a low volatility environment as long as the VIX remains below 20. We're at an 18 handle now, which means we're getting a little bit closer there. We got down to sort of the mid upper teens on the rally in April into early May. If that 20 level breaks again, that could be a sign of the next leg down, sort of that, a corrective move after this rally, the gap higher earlier this month and the continued uptrend. But for now, the VIX remaining in a low volatility environment below 20. As a reminder, I do see some great, comments and some questions coming in as we go. The question lines are open here on any of the live stream destinations: Facebook, LinkedIn, YouTube, and X. Anywhere where you're watching the stream live, you can put a comment in. Anywhere where you can see to do so. I can see all those live as we're going through the show. Would love to take a question or two at the end of the episode. Anything we don't get to, we'll put in our mailbag. We had another all mailbag episode on Friday. It was a really good one. Some really thoughtful questions from all of you guys. I like that Friday episode where we can spend a little more time deliberately going through and talking about some of the great questions that we've received and giving a little more long and well, hopefully articulated answers. So keep your questions coming. All right, looking at interest rates. So interest rates opening a lot higher, right? So the Moody's downgrade. I mean, what's interesting about that, to be honest with you, I mean, it's a bit of a non-story, but I mean, only a bit. I mean, it's not good, right? It would be better if Moody's is not downgrading the U.S. That's fair. But remember that the other two rating agencies, Fitch and S&P already downgraded the U.S. That was a news story we digested quite a while ago. And it's all, the same themes that are sort of chronic long-term themes that are, arguably plaguing the U.S. right about now. Incredible deficits, tax bills being spent that don't really make any progress in changing that picture, sort of adding to a growing deficit. And so the debt load of the U.S. looking less and less sustainable. Now, the reality is that the U.S. can run a deficit for a long time, and they have the ability to print out a ton of money to allow them to do so. So, when does the bills come due for that debt load? Like it appears like never. So it's sort of a, it's not great, and it would be better if the U.S. Was not downgraded. However, it really sort of reflects a lot of the things that we already know, right? And it's not really new. I mean, it would be surprising if that wouldn't happen, given all the realities that we've seen in terms of the U.S. issuing debt, taking on, again, huge deficits that are just ballooning more and more, regardless of who's who's running the administration at any given point. However, for today, with short-term reaction, what you'd expect is for rates to go up because basically, higher risk means higher yield, right? That's why high yield or junk bonds or bonds of risky companies, investors require a much greater yield for taking on that risk. So U.S. Debt being downgraded, basically you expect rates to go up is how I would generally think of it. We did see that out of the open, with the long bond yield briefly going above 5%. By the close, we were down around 494. But I would be, thinking about that potential reality where interest rates push higher and stay higher for a little while. And that's a long-term trend we've been talking about for a while here. I think that's the long-term secular trend in rates. We've just been in a period where rates have kind of come back a bit in the recent months. However, looks like this could be the beginning of further upside. Now, after rates started a lot higher, bonds opened a lot lower. They did rally through the equity market sessions. The TLT was down about 1/3%. 5-year, 10-year, 30-year points all higher. They were a lot higher earlier in the day. Long bond yield finished around 494, 10-year point 448, 5-year point 408. The dollar moving lower. Let's see, the UUP down about 2/3%. Looking at the commodity space, gold, continuing to recover after sort of a pullback experience. Last week, we talked all about the GLD testing its 50-day moving average today, bouncing after last week's pullback phase. We'll see if that's sustained. But overall, I would say the GLD holding an ascending 50-day moving average. That's not too bad. That's choppy, but not horrible. Silver price is up a bit. Copper price is up 1.7%. Crude oil up. Natural gas was down. The rest of the commodity space generally doing okay here. Cryptocurrencies chopping around quite a bit. Now, the tape is going to read down 1%. But what you have to remember is Bitcoin, Ethereum, and other cryptocurrencies basically trade 24/7, right? They're always open. And so the close is an arbitrary point within the 24-hour period that is sort of identified as the close, right? Having said that, just like other currencies, they trade 24 hours. So the close is kind of misleading. So what I like to do is just look at the trend over a short period of time and see what's happening. And you can see that in the last 24 hours, Bitcoin briefly broke above 107,000. So we are literally at new all-time highs right now for Bitcoin. Chopped around quite a bit during the equity session after the U.S. equity markets opened. Bitcoin had come down to almost 102,000, but currently trading around 105,400, and that's where we're at right now. So overall, the chart of Bitcoin looking pretty decent here after pulling back earlier this year, rotating back higher, retesting those previous all-time highs. Ether prices up as well, currently trading above 2,500. Ether was pushing above 2,650 over the weekend. Again, currently just back over 2,500, but pushing higher about 150 points in the last 6 hours or so. All right, looking at the 11 S&P sectors, what we would consider sector breadth: 8 higher, 3 lower. So out of the 11 sectors, most of them up today. Healthcare at the top of the list today. So again, while this felt like a nice sort of rally through the course of the equity session, it wasn't the growthy leadership. Technology was actually down today. Consumer discretionary was actually down today. It was healthcare, which has been a bit of a dog here in recent weeks, moving higher about 1%. Utilities, the XLU, was up 0.4%. Industrials up about 1/3%. We're going to focus a little bit, maybe briefly, during the chart review session about industrials, because I've seen a lot of really encouraging charts in that space. If you scan for stocks making new 3-month highs today, you're going to find a lot of industrials in there and a lot of other sectors represented as well. But industrials have really started to improve. It's defense stocks, it's business services, it's a bunch of things within the industrial sector, all looking pretty good. On the downside, 3 of the sectors were down. We mentioned tech and consumer, both down less than 1/3%. Energy, the worst performer, down 1.3%. That energy at the bottom of the list is not a new thing. I feel like that's a pretty common repetitive feature of this show, as we talk about energy not looking great with crude oil prices remaining fairly low. Looking at the breadth data, it's kind of okay to bad, depending on what cap tier you're looking at. So which size of companies. If you look at the S&P 500 right in the middle, almost a coin flip between stocks up or higher, advancers slightly edging out decliners, but not by much. But if you go to mid caps, and again, the mid cap and small cap indexes were both down today. The mid cap index 2-to-1 ratio down versus up, and a little bit even worse for the small cap index, with 72% of the S&P 600 moving lower today. Roll that up to the New York Stock Exchange, pretty decent broad list. You have 56% higher, 41% lower. So I think those breadth numbers are pretty important to watch here. One of the features of the rally from the early April low and really into the month of May, as the S&P gapped above 5750, we've seen stronger and stronger breadth readings. And we've highlighted the impressive run that we've had in the percent of stocks above their 50-day moving averages, the bullish percent indexes, which are both above 70% right now. The NASDAQ's bullish percent index is above 80% right now. So declines in breadth right about now could start to tell you that investors that have been all bulled up since early April, and certainly increasingly so, are starting to take on a more cautious tone. We're seeing defensive sectors rally today. We've seen defense, do well a couple days last week, but the breadth has been so strong that kind of everything's working. If you start to get the sense that everything's not working anymore, that is one of those great red flags after a rally like we've experienced in the last 6 weeks after that early April low. Well, I'll show you the market trend model, but just as a reminder, if you missed it, as of last Friday, our market trend model for the S&P 500 turning bullish on all 3 time frames, and it's been a little while since that's happened. We'll look at the chart here in a moment, and you'll see what I mean. But when the market trend model is bullish on all time frames, I should be willing to take on risk, focusing on areas of the market showing strength, and that's why something like industrial is really impressing me from a technical perspective. The Magnificent Seven and Friends, these leading names, we can see Microsoft up 1%, Broadcom up 0.9%. After that, not great, right? I mean, a lot of these names were flat for the day, like Netflix and Meta basically were unchanged from Friday's close. On the downside, Tesla down 2.25%, Apple down 1.2%. All right, as we go on to the market carpet, what we call the heat map style portion of the show. Matt, thank you so much. I see your super chat on YouTube. I appreciate that so much. Those of you guys watching on YouTube, if you have the ability to do a super chat, which is throwing in a tip during the show, I really appreciate it. It's so thoughtful. Thank you so much. You mentioned enjoying the different perspectives from your guests. The Market Misbehavior podcast has been a lot of fun. We had some really good interviews recently, which I hope you enjoyed. Gary Antonacci, author of Dual Momentum Investing. That's one of my top 3 books about investing. Really just it makes the case for trend following momentum, and some different, basic thinking about momentum investing. I really appreciate his work. Had a chance to talk to him. He's had incredible experiences working with some pretty successful traders. So I hope you enjoyed that one. Nick Raish of the Earnings Scout, Urian Timmer, one of my former Fidelity colleagues, and many, many more. Some really awesome guests lined up here. If I remember right, tomorrow, actually, I'll give you a quick preview because I have it in front of me. Let's see. Tomorrow, we're going to interview Jesse Felder. He's the author of the Felder Report. I've interviewed him many times. He got his start as a market commentator on stock charts with the public chart lists on stock charts, and I reached out to him years ago. He's a really knowledgeable technical analyst and a really thoughtful investor. Just a really pleasurable conversation. And then Chris Verone, who's the technical analyst at Strategas Research Partners based in New York. Chris is awesome and has a wide following in the institutional community. We'll pick his brain on what we're seeing. So Matt, thanks so much for the super chat. I'm glad you enjoy the podcast. If you have suggestions on who else we should bring on, please let me know. All right, let's look at the heat map and see how things are playing out here. I mean, kind of a not a great day if you look at the heat map. And if you follow the show here, we always focus on this visualization as just a sort of the quilt, the landscape of the markets and what's working and what's not. But we start with sort of a high level review, right? What's your general impressions? My general impression is not what a great day for stocks. This is sort of this is a meh day, right? Some random things up. And again, focusing on things like in healthcare, UNH up 8%. UNH has not been particularly strong here. This is bouncing off of a low after getting cut about 50% plus since a peak in mid-April. So great that it's up 8%, but we're coming off of very oversold levels. I would say much more you'd want to see before you really believe in that kind of chart. Gilead, right? Biotech popping up here, 3.5%. Nice bounce off of 100. That's a big round number support that we often like to focus on. But elsewhere, you can see Moderna up 6%, Humana up 4%, Biogen up 3.1%. Now, again, if you're more of a contrarian, bottom fisher, buying severe weakness kind of investor, these could be very compelling charts to you. Personally, I'm much more of a let the chart tell you it deserves a place in your portfolio by starting to show signs of accumulation. I would argue many of those still waiting to see if that develops, but certainly something I would be watching. Another thing that stands out to me looking at the heat map today is just the big names not particularly strong, right? I mean, this market has been driven in a lot of ways by mega cap stocks doing so well, right? So here's like the last 1 month returns. Microsoft up 25%, Nvidia up 34%, Alphabet, like the worst of this bunch, up 10%, Apple up 6%, but a lot of these names up, double digits in a pretty big way in the last month, which is why a day like this is like, what happened? What happened, big guys? Where are the big dogs on this day here? And I think that's, the real, besides weakening breadth, I think these mega cap names no longer taking a leadership role, just certainly, while it might not weigh on the market to the downside, it certainly limits your upside because the S&P and the NASDAQ are driven by the Magnificent Seven. So Alphabet, Meta, Netflix, Amazon, Nvidia, these are unchanged today, basically, right? Sort of flat from what we saw from Friday's close. Elsewhere on the heat map, energy continuing to be an underwhelming bucket of charts here. And again, I mean, that in a lot of ways, at least these names in the S&P are plays on crude oil prices. They've just not been great. From a technical perspective, there are just so many other areas in the market that have been so much stronger. And so I would say energy, underwhelming again on a relative basis. The charts are not really telling you too much to be excited about. DG, someone mentioned in the chat, having a nice upside rotation. I didn't grab that for the chart review, so let's look at it now because it's a nice breakout here. Dollar General for me, and a lot of the dollar stores have kind of a similar look. Really interesting area of the markets. I would say from a technical perspective, these are impressive charts. What I like about the chart of DG is it's rotated from a distribution phase to a consolidation phase to an accumulation phase. Now, people have different sort of names for this. And that's a terminology I kind of just have started using years ago and just have kept up with it. It makes sense to me. I think of a market at any point in one of three phases. We're going up, we're going down, we're going sideways. We're going up, it's an accumulation phase where buyers outnumber sellers. In distribution phase, we're going down, sellers outnumbering buyers. A sideways equilibrium phase, or what I call a consolidation phase. Buyers and sellers are in equilibrium. So the way that you think about charts and trends is that are buyers in control, are sellers in control, or are they in, even? Are they in harmony? And I would say the chart of Dollar General went from a clear distribution phase of lower highs and lower lows to a consolidation phase, basically sideways bottoming trend, to now an accumulation phase. And what makes it an accumulation phase, the momentum improves. So the RSI is overbought on rallies and stays above 40 on pullbacks. We're above moving average support instead of being sort of languishing below it. And most recently, we've been in sort of a short-term sort of sideways move here between support around 85, 87 and resistance around 97. Today, we appear to be breaking out above that resistance level. So I'd love to see follow through tomorrow, right? What we call a follow through day, which means we've broken out. Do we get an additional sign that it's not just a fluke and that there's further accumulation? But I would say this is a chart that has a lot of upside potential, a lot of room to run, a lot of daylight above current levels. So thanks someone that mentioned DG having a good day. I would agree. I think that's a really compelling chart. In industrials, I think a lot of the other charts, if you would ask me, pick a random sector where the average chart's pretty decent, I'd probably say industrials right now. And I have a couple of those highlighted. Some of these are pretty extended, like an HWM has been in a pretty good run. But it's some of these other ones that are, just starting to break out where you feel like there's more upside potential there. All right, we will continue on now with the chart review portion. Before we get do want to let you know we have a free webcast coming up this Wednesday. If you watch the show and you enjoy it, imagine a whole hour of this, right? But we'll talk about a specific theme and dig a little deeper. I like doing these about once a month. We're going to do a webcast on Wednesday of this week called Sell in May 2025, Seasonal Strategy or Outdated Myth. You can sign up at marketmisbehavior.com/May 2025, or just scan the QR code that you see on your screen. We're going to look at the seasonal tendencies. Often when we get to the month of May, someone starts throwing out the Sell in May comment. That is a thing because for the longest time, selling around May, buying back in the fall has been a pretty decent way to play the markets. What you'll find and what we'll go through in the webcast, last 5 years, it's been very different. And I'll show you what the short-term evidence has looked like compared to some of those longer-term sort of well-documented themes. And then we'll talk about some of the charts that we think are important to follow now to sort of gauge how the market's playing out relative to those seasonal tendencies. Again, you can sign up for that free webcast at marketmisbehavior.com/May 2025, or scan the QR code that you see at the top of your screen. I see another super chat in there. And by the way, Tony, thank you so much. I appreciate it. As always, very, very generous and very kind and thoughtful. And I appreciate it. Thanks so much for that. All right, let's go to the charts. Where did I put the charts? Oh, over here. All right. So we'll start with the daily chart of the S&P 500. I actually did a show on Stock Charts TV earlier today. I'm not sure if it's posted just yet, but I do a weekly show on Stock Charts YouTube channel every Monday. And we talked about price gaps. And one of the charts we looked at was the S&P, right, with the recent price gap earlier this month. So the S&P went from below the 200-day, from above the 200-day. And I think that's important. But after a gap, what happens after that gap is so important. We're going to look at First Solar, I think, in a chart or two, and you'll see how it did not do what the S&P is doing, which is the gap and run, right? We gapped higher. We see additional accumulation. We're just barely not overbought, but we're a rounding error away from the overbought region on the S&P, which just tells me, boy, we've had a really good run. Look for signs of a downside rotation. I wouldn't be surprised if we get a pullback. I sort of thought after Friday's news, after the close about the Moody's downgrade, that seems like the kind of catalyst where you could see the market going lower. We gapped down at the open. We had a lot of buyers coming in. Certainly a lot of optimism coming in through the course of the trading day, continuing this run that we've experienced off of the April low. But I think the performance post-gap has been pretty important. And I would say that's encouraging. I would also say holding that pullback level is vital. And I think that's where, paying attention to price gaps as a support range or a resistance range can be really meaningful. Here we're watching that shaded area on the S&P. The 200-day is right in the middle of that. I would say holding that is pretty important. If we do get some sort of corrective move this week, that's the level. That's the line in the sand. I think anything above that is still pretty okay. Anything below that is starting to be not okay. And that's what we'll have to talk about, what a pullback could look like, potential downside targets, et cetera, et cetera. But for now, I give the S&P room down to that shaded area as normal noise. That's normal volatility. Anything below there could be something more significant. For now, watch the RSI as we approach that overbought level. The market trend model, which we keep updated, we update it every Friday after the close on Stock Charts. If that's your platform of choice, there's that widget that I showed earlier. You can add it to your dashboard, which is a really cool add-on. I think it's free. As a member, you have access to it, and it just monitors where the market trend model is during the week, which is pretty helpful. Market trend model for me turned bullish on the medium-term time frame as of last Friday. The medium-term model turned bearish at the end of February. That was after the February peak. remain bearish through that sell-off, certainly remain bearish through the, the rally off the April lows. So for about 4 weeks, I've had my medium-term model remaining bearish, but the short-term model turning bullish in mid-April. So that says counter trend rally within a cyclical downtrend, but the medium-term model turning back bullish tells me we're back into a cyclical uptrend, and the trend's now confirmed as a bullish phase. The last buy signal we got was back here at the beginning of November of 2023. I can't guarantee we're going to get another 2024. That seems pretty extreme, but it certainly tells you, we're at a recovery period. At least that's what the model that I follow is telling me, which means things are pretty good until the market trend model would go back below zero. That's what you look for, which would tell me this rally off of the lows now starting to subside. So we're back to my market trend model being bullish on all time frames. That tells me the market is firing on all cylinders. You look for first the short-term model to turn negative, but until that happens, we're long and strong up and to the right. Now, the way that the S&P and the NASDAQ have been driven higher is because of the mega cap leadership names, those growth stocks that we talk about often, Meta, Apple, maybe not Apple as much, but Amazon, Alphabet types of stocks. But it's also because of the improving breadth conditions, right? The advanced decline line on the S&P 500 made a new all-time high at the end of April, and in the month of May has continued to push higher. Now, these other advanced decline lines are not quite making a new all-time high, but they're really, really close. And for a lot of these, it's the high from around Thanksgiving of last year, late November, that we're sort of eyeing, right? If you look at where we're at and look to the left. So the S&P breadth, resoundingly bullish. The breadth on these other ones still not quite confirming a new all-time high, but if that would happen, I think that means a pretty strong breadth reading. So the advanced decline on the New York Stock Exchange, pretty important to watch. I have seen some people talk about the 80 line already breaking out. There actually are some different ways you can measure that, whether you're looking at common stocks only or all New York Stock Exchange listings, whether you're looking at value or just price action. So breadth data really doesn't have a consistent kind of industry standard way that it's reported, which is probably unfortunate. Yeah, every charting provider kind of has their own methodology, and there's no real consistency between different platforms. So if you're comparing like an advanced decline line on different charting platforms, you can get very different results because it's all about the methodology of those shops. And I can speak pretty well to the methodology used at Bloomberg and at Stock Charts because I've worked at those places and I've talked to the developers and I've looked at the data and I can tell you what they're doing. But other platforms, it's your guess is as good as mine in terms of what data they're using and their methodologies. Sentiment. I don't think I talked about sentiment on Thursday of last week. I may be wrong, but I don't remember doing it. And if that's the case, sorry for that. I usually try to remember to do the weekly sentiment data on Thursday, and if we missed it. Last week, the AAII bullish reading went up to around 36%. The bearish reading came down to around 44%. So the spread from bulls to bears, the spread from bulls to bears still very much, favoring the bears, but in a very narrowing way, right? The last 2 weeks, we've seen less and less of a gap between bears and bulls, and there's been more bears than bulls really since the beginning of the year, since the end of last year. Now that pivot, if we would see a pivot from, bears dominating to bulls dominating, that's actually pretty common in new bullish cycles, right? When you see sort of an upside rally, with a notable exception, summer of 2023 was where I was looking, when you had bulls finally outnumbering bears when you got to this point. And then about 2 months later was the, significant pullback into the October low. We actually went to more bears than bulls. So my point of saying this is it would be pretty encouraging, generally speaking, if you would see this histogram at the bottom, which is literally the bulls, the percentage of bulls minus the percentage of bears over week. If we would get back to bullish readings, that usually is the beginning of a nice recovery phase. So again, pretty encouraging sign sentiment-wise. All right, we'll finish off looking at a couple charts. I'll take some questions. We'll be done. Applied Materials rallying up to a descending 200-day moving average last week. The last time we attempted to get to the 200-day, we failed with a shooting star candle and then a gap lower, what we call a breakaway gap to the downside in mid-January. Unfortunately, we had a very kind of similar pattern here. We didn't have the shooting star candle, but we did close above the 200-day and then have a gap lower, and that's usually not a good sign. when you trade up to resistance and then gap lower. That usually means a breakaway gap or an initiation gap, sort of a gap implying a new move, a new trend. Breaking back above the 200-day would probably negate that bearish gap setup, but I would say the gap below 170 kind of a problem here. So the good news is Applied Materials sort of opened lower but closed back at Friday's close. But I would say watch that for sure as we tested the 200-day, declining 200-day overbought conditions, very similar to January, and for now gapping lower. Speaking of downside gaps, First Solar had a gap higher in early May. This was when there was a announcement related to green energy, and I forget the details of it, but I remember it, basically being less negative about solar stocks. And so while some of the other renewable energy stocks got beaten down about a week ago, First Solar and some of the other solar names actually gapped higher. The gap higher took First Solar above the 200-day moving average and briefly above the first Fibonacci resistance level around 190. Unfortunately, Thursday, Friday of last week, rotating back lower, and today we're back into that gap support. So a range like this, I kind of consider that a support level, which means the bad news is we're back into that gap range. If we can hold that, it's not that bad. We're pretty close to closing that gap, which would be a very concerning sign for First Solar. I mentioned industrials, the XLI, similar to the S&P 500, gapping higher and then running over the last week. The XLI is overbought. A lot of things are right about now after the run we've had out of the early April lows. But the relative performance in 2025 is what I want you to focus on. Because even though on an absolute basis, we're just making new all-time highs again today after Friday's gap above 143, the relative strength has been pretty consistently positive in 2025. And there's sort of a couple different types of charts that you'll find if you start scanning through the industrial sector. And I encourage you to spend some time looking at the charts there. Charts like Howmet and others have had really good runs, right? Howmet's been in an uptrend for the last 12 months plus. HWM made a new all-time high, gapped up above 140 at the end of April on earnings. That was actually the beginning of May, and has continued to run higher. But you can also see the stock or the ETF has become overbought. But also we can see that the gap has been followed by a move higher. But Howmet feels pretty extended because it's been running for quite some time. So within the industrial sector, I'm a much more of a fan right about now in terms of tactical entry points. Stocks just starting to break to new 3-month highs. That's a scan that I run often. Stocks making new 3-month highs. You'll find things like Howmet, aerospace names, which have been in really good runs for a while. You'll also find names like L3 Harris, ticker LHX, which is just making a new 3-month high on Friday. Today, continuing to push a little bit higher, but I would say breaking above the 200-day, breaking above the 4-month, 5-month base, pretty encouraging rotation. So I would say the good news about industrials, besides the fact that it's been performing pretty well, you have names like LHX, which are coming up on the scans of new 3-month highs. That I think is pretty encouraging with more upside potential. All right. Let's take a question or two. And again, I appreciate the super chat, you guys. That's really, really thoughtful and much appreciated. Let's see what sort of questions we get. Dave, Richard, thanks for watching on YouTube. He said, Dave, the S&P ended the day up and the VIX ended the day up. What's going on with that? Yeah, I actually, years ago, I remember interviewing Dave Landry, who I actually haven't had on the podcast now that I think about it. That's a mental note to get Dave on the show at some point. But Dave and I talked about the VIX. I would also say go back to my podcast interview. Richard Stumpo, I want to say he's an author. Is that right? He wrote an article on the VIX, or wrote a book on the VIX. I think that's true, but let me make sure that that's true. Russell Rhodes, sorry, that totally made up that one. Russell Rhodes, I interviewed at the end of December. He wrote a book about trading the VIX. Jay Soloff, I interviewed at the end of March. Great discussion about what the VIX actually represents. I would encourage you to go back and review those discussions because we talked all about the relationship between stocks and volatility. But the short answer is the VIX can move higher when the market moves higher. What you have to remember is the VIX is not, we think about the traditional inverse relationship between the S&P and the VIX, right? When stocks move higher, volatility tends to go down. When stocks go down, volatility tends to go up. And the way that that kind of logically makes sense is when people are kind of confident and accumulating position, it's usually kind of calmer. People don't panic buy too often, although FOMO is certainly something we'll see. But generally, the markets kind of go up the stairs or go up the escalator. They go down the elevator, as one of my mentors, Ralph Acampora, used to love to remind me often. And what that means is when we panic and unwind positions, we usually do so very suddenly, very quickly, which means the VIX is a fear gauge, right? That's because when people panic, volatility starts to increase because all of the trading creates a lot of volatility, which creates further fear, which creates further trading, which creates further volatility, and round we go. But that doesn't mean that on a day-to-day basis, we can't have stocks and volatility both going up, or we could have stocks and volatility going down. And what you have to remember is the VIX actually opened above 19 and closed down toward 18. So the VIX actually did come down through the course of the day, but it's still higher than Friday. And so what that means is today's move was marked by more volatility or more expected volatility than we saw on Friday. The VIX is literally looking at the options market, the S&P index options, and using some measurements in there to sort of imply a volatility for the S&P. So what this literally means is that volatility in the S&P options market was higher than it was on Friday. That usually would happen when stocks go down, but not always. And so, so again, that's kind of what it means. There's that inverse relationship, which tends to be true, but on a day-to-day basis, you will find days where stocks and volatility go up together. Stocks and volatility go down together for sure. Great question, by the way, and I hope that helps. One more question. Let's see. Yeah. So one and Jeremy, thanks for watching on YouTube. You said Moody's is late to the game. They were the last to downgrade. I think that's one reason why you didn't get a huge, a much bigger reaction. Again, although we did open a lot lower. What you have to remember is that the other two main rating agencies, right? There's three rating agencies, Fitch, S&P, and Moody's. The other two downgraded the U.S. a while ago. And I remember that first downgrade, it was like, whoa, like, is that even possible? Because the idea of the U.S. government being downgraded did not seem like it would be reasonable. And in a lot of ways was a wake-up call at the time for, wow, maybe all of this, additional debt and deficit spending is not great. Hasn't really changed the behavior of administrations we've had, which you continue to spend aggressively on a lot of different things. And whether it's spending on social programs or spending on defense or spending on whatever else you think is a reason why it's being done, it continues to be done. I mean, I think the real issue, or I guess the challenge, is what are the long-term implications? What's the downside for all this deficit spending? And if you tell me, well, at some point, it comes due and all of a sudden we wake up and the markets go down aggressively because the U.S. can't keep up with their debt, that you could have said that for a long time. And the problem is deficits continue to grow. The U.S. economy appears to continue to grow pretty well. I mean, if you look at the end of 2024, deficit essentially at all-time highs, the market's growing pretty well, right? So, I mean, and risk assets are doing okay. So it's like, at some point, is that a problem? Maybe, but it hasn't been a problem yet. And again, that's why I find balancing the macro, which is one of the pillars that I follow, with other things, particularly trends and momentum, as Gary Antonacci and I talked about on the podcast last week. I think that's what's important, because regardless of what you think could happen, the market doesn't care what you think. Follow the trends. Folks, that's our show for today. Thanks so much for joining me here on Chart This with Dave Keller. Hope you had a great weekend. Hope you enjoyed the show. We'll see you back here tomorrow. And in the meantime, remember, it's always a good time to own good charts. Have a good night, folks.